more loans to the known people or favored people, and it is diverted. And today we are seeing all those NPS. So selective credit control. So not this control is in quantitative and rate, interest rate. Further, they have taken measures, credit control measures, extensive branch. So expansion of the branches. At the time of 16 and only 4,000 branches are there. Now it is over 5 lakhs. So this helps in mobilizing the savings into investments. Refinance facility to share risk and also cost of banks funds. So this is here only that in case of refinancing, they projected them as a sick and not doing financially well. They raised further funds, and they fails to repay. So if we had seen, see, for that purpose, the present government has introduced a new act also, Insolvency Act. And if you observe, Google it, you are able to know how many companies are in that line. Many public limited companies, private limited companies are in that queue in thousands, nearly 50 or 60,000 entities are scrapped. All they are window dressing firms, not for actual purpose they established, just for raising the funds and misutilization of these funds. So finally, better needs for economic, all these are better needs for economic development, create more jobs, so that is increase in job opportunities, and fulfillment of plan objectives. To promote the plan objectives, these financial entities will pump the resources, funds, servicing maximum population by expansion of branches, setting up committee to study the present situation and getting the advices for further development. That is Tandon committee was set up in 74. Then bank credit to priority sectors. So identifying the sectors which are more important for accelerating the growth. So identifying them and set as a priority. So for each and every bank, that priority will be set, that different priorities. So if it is rural agricultural development, if it is in SEZ for industrial development, so so like that bank is a lead bank. It has to give loan for that particular priority sector. Then the LIC, so it's a big entity. It support many times, and especially in the time of financial crisis, we had seen that everyone we observed that 2009, 2008 subprime issue and others. So world market is melted down. Then the LIC stands to support our Indian market. So mobilized massive long-term funds and single largest organization with large long-term savings. See, that's the beauty. In everywhere, in other banks, you will save the money for shorter period. You will deposit today and tomorrow you will withdraw. It will not remain in that bank. It's not parked for a longer period. Where in case of LIC, just you are going on depositing. So the term will be 5 years, 10 years, 15 years, 25 years, 30 years. So if in your case, you people start earning from within 2 years, so yours period will be more than 30 years, 40 years. So that much of time, that amount will be parked in the LIC. So the long-term savings. The dominant role in underwriting issues and direct push of industrial activity. So they fund for industrial activity. So that LIC helped in price stabilization during the downward trend when market faced a crisis due to turmoil in the global finance market in 2008, that is subprime issue. Then just a glance, this is not the present one. Somewhere in 4 5 years back, the total premium collected by the LIC is 87,108 crores. Number of policies 509 crores, 5 crores, 5.09 crores, and number of agents more than 10 lakhs. Just their rental income per annum is 7,000 crores. They're having their own buildings. So apart from their activity, they lent that for other entities. So from that, they are getting nearly 7,000 crores. So if we take the private insurance companies, so in that ICICI Prudential is the bigger one. So their premium collection is 6,813 crores. So it is less than the LIC. And another thing is the awareness of insurance is very less in India. So people are not having that much of awareness and taking the help of this insurance. At present, the Modi had introduced the for everyone it's an insurance. So like that, it is spreading. But if we compare with other countries, the insurance is very less in our country. If it is in that way, then the insurance companies will get more funds. Then protections like this, they strengthen the financial institutions. Now the protection to the investors. So if the investors having trust in the entities, then they will invest the money in that entities. So we had seen that Yes Bank recent days. So everyone went to bank for withdrawing the money. So later it is taken by the SBI. Then slowly it start recovering. So building up confidence of investors. So shattered due to distrust in private limited. So far we experienced that. So to build up the confidence in investors. So redesigning the legal and administrative setup of companies. Then ban of, so those days the forward trading and then some middlemen and managing agencies system was there. So that system was abolished. So for legal and administrative uh, instant thing, that some steps were taken. The Companies Act 56 was introduced. Now new Companies Act came up with some modification. Then capital structure, Capital Issue Act implemented through CCI MOF to regulate the capital issues and foreign investment. So this foreign investment, this is again repealed in 1992. Securities Contract Act. So to regulate and monitor the Securities Contract Act. So securities, purchase and sale of securities. So it is directly linked with the stock exchange. And Monopoly Restricted Trade Practices Act to control monopolies. And Foreign Regulation Act in case of foreign investment. Then participation. These are all the some measures taken for protecting the interest of the investors. Then participation of financial entities in the corporate management. So all these financial entities had given loan. Later that loan is converted into equities, share capital. Then it is converted into share capital. Then they become the directors of the company. Then they started ruling that company. So like that, they enter into the management of the corporate sector. So the financial institution like IDBI, IFCI, ICICI, IRBI, SFC, SIIC, etc., and LIC, GIC, though the conversion of loans into equity, they become or nominated as a directors and started controlling the organization. Then the organizational deficiencies. So first, the setting of the financial institutions, then strengthening them, then protection to the financial investors, then participation into the management, then finding that organizational deficiencies. So now the organizational deficiency, so the institutions which are set up are not sufficient to meet the requirement. That distribution mechanism is not correct and it's not meeting that requirement. So in institutional structure, we are having that development banks and insurance companies and banking, but so the keeping in that requirement is not sufficient with the existing entities. So form of financing, term loan was main part of the financial structure with little part of the equity capital. So the loan is the main source. Investment is very less. Sometimes institutions become more. So that is this is the thing, sympathetic and permitted more than the desired finance in case of strain and default. So that become default. So the all government entities, public sector, development banks, IFCI, IDBI, ICICI, and SFCs are become precaution because of all this misuse of that funds. Then small and new enterprises system was unable to meet the financial requirement. So then for small and micro entities, it is very costly and getting the funds is not so easy. Then for raising the funds from the public as a capital, so that issuing mechanism, the management or mediator or the facilitators also not that much. So that is merchant banking and the service providers for raising the fund. So that is underwriters. Now all private banks and are equipped with all these facilities. So if you had seen the summary of this financial system, so public or government ownership of financial entities, then that entities are fortified for farm and investor protection. Then all these entities are enter into corporate management, 4 phases. So first is nationalization of entities. Reserve Bank of India setting and State Bank of India, they had taken LIC, they set up some banks and GICs. Then introduced new development banks and UTI. So if we fortify the same, so development financial institutions, IFCI, SFC, and ICICI, ADBI, SIDBI, and IIBS. Then banks, then LIC and UTI. Then for protection of the investors, they introduced Companies Act, Capital Issuing and Control Act, Securities Control Act, Regulation Act, then Monopolies Restriction, Restrictive Trade Practices Act, and Foreign Exchange Regulation Act. So this is a nutshell of financial system. Then the main phase or main twist is taken at 1990. Then the Prime Minister P.V. Narasimha Rao invited the outgoing governor of the Reserve Bank of India, Manmohan Singh, to take a charge of finance portfolio. So then he accepted and became a financial minister of the country. The brainchild of the P.V. Narasimha Rao are instrumentalized by Manmohan Singh. Due to that, we are able to see the economic growth and development. They introduced the privatization, and all those things are done by Manmohan Singh as a finance minister, but he is not keep hold or continue them being a prime minister for 2 times. If he did that one, today's position is different, quite different. The 10 years is much more time for implementing and continue promoting the thoughts of P.V. Narasimha Rao, but he failed in that. So the main, if we study the growth of India, these 10 years is spoiled the entire growth. Otherwise, our economy will stand some other. So development, say that period, the privatization is started, disinvestment is started. Later, now we are entering into the globalization. So development financial institutions, DFIs, started providing working capital also. Earlier, only the long-term finances they are providing. They started providing working capital also. Credit rating agencies to identify the credit health, financial health of the organization, the credit rating agencies. So the rating indicate that they are financially good, sound. So the people are able to invest in those funds by taking the help of that foreign entities, Standard and Poor and Moody and Fitch, like that, with their participation or help or their investment. We started CRISIL, ICRA, IFCI as a credit rating agencies. Then started privatization of DFIs. So that the main 1990 is the era of inviting the private people or converting the existing government entities into private. So our disinvestment. Disinvestment means not the totally it is given to the private. Some portion is, see that total ownership of an entity is 80%, 100% in the hands of the government, 20% is given to the public. So private, public in the sense private. So 80 is in the hands of the government and they disinvested their 20%, 30%. So in say case of banks, up to they hold only up to only 40%, the 60% is disinvested. So privatization of development finance institutions. Then reduction in government holdings and public participation. Example, IFCI, IDBI, and ICICI are slowly diluting their investment. Issue of so then all these entities, when converted into private and public, then they started raising their own form of resources. So far, it is assisted by the RBI and other financial institutions, government. Now they started raising their own funds by issuing bonds. And government without government guarantees, and they started their own resources. So reduction in holding of government in banks and public participation by listing. So by making the companies shares as listed in the stock exchange, they sold some part of that investment to the public. Government holding reduced even by up to 40%. Setting up of universal banks. One-step banking, capital adequacy, the Basel rates, assets classification, that one only is introduced. But the assets for banks and financial institutions, the asset is the borrower is an asset, receivables. So if it is a regular, good, problematic, anxiety, causing, non-performing, performing, non-performing. Performing means they lend the money and receiving interest and installment properly. So it is performing. Again, you will collect the fund and again you are giving that fund for loan. So it is performing. If it is stopped, you are not receiving interest and you are not receiving installment. So it is not performing. You are not able to reissue them as a it is not in circulation, then you are not able to, it's blocked, you are not able to repay as a loan. So it is non-performing asset. So this is the major issue at present. Raghuram Rajan has addressed and he had warned the government and the banks for addressing of NPA. In his regime itself, it started. So all these are repairing is taken place by this government. The result we are able to see in the next coming years. Focus on non-fund business like licensing, controlling, then guarantees, acceptance, forex, for them giving guarantees, funding for them, promoting signature-based and consultancy services like project counseling, merchant banking. So all these are new models. Issues management, capital market related activities, merger and acquisition. So for these entities will help in these situations. So you are going to buy the existing A firm is purchasing B and C and merging them into A. So there is merger, acquisition, reconstruction. So the existing is changing into some other models, reconstruction, the entities, organizations, all this. Not an asset. So merger, acquisitions, reconstructions, debt syndication, trusteeship of debt, sponsoring mutual funds, wealth management, sales, and so the financial entities are enter into new phase of activities. All they are giving assistance and help and promoting these activities. New private sector banks are emerged. Axis. So this is with bifurcation of UTI, Yes Bank, HDFC, Kotak Bank, Kotak Mahindra Bank. Then the new rating system is introduced, that capital adequacy, assets quality, management, earning, liquidity, and systems and control. So we call it as CAMELS rating. So all these are 90s, later 90s, with the in 90s changes. Then the mutual funds. In 90s later, the mutual funds were emerged. So by earlier it is UTI. The main intention of is promoting the investment in the securities. Later they bifurcated that into two different entities. One is banking and another one is mutual fund. So that UTI stands as a mutual fund and another one is bank. Then the banks, broking houses, financial companies, insurance companies, private sector, and in foreign, with the help of the foreign collaborations, FIS, merchant banks set up all these existing entities, set up their mutual funds. Either it may be a subsidiary or a independent entity, or new entities also emerged in the mutual fund services. So the intention is help the small investors in big way. So everyone is not aware of investment in securities. So these people collect the money and experts, that fund managers will take care of investment. So this will become the backbone for capital market. So nearly 1,000 companies are there. Examples are AIG, Baroda Pioneer, Birla Sun Life. So all these are some mutual fund entities. And they are having different types of funds, equity-based funds, balanced funds, bond funds. So all these are some example of funds. Then summary, collection of savings and distributions for industrial investment. So the raising that unutilized funds is called savings. That savings are converting into industrial investment. stimulating the capital formation and accelerating the economic growth. So the structures, regulatory bodies, financial intermediaries, and for exchange of these instruments, financial market, and financial assets instruments. If the financial assets and instruments are there, then that will be traded. That place where we traded, that is financial market. For providing that financial market activities, we need financial intermediaries and banks. To regulate all these activities, we need regulatory bodies. So up to 1951, it is totally in the hands of private sector, and 51 to 90, a public. Then early 90s, privatization. Present situation is globalization. Then the nutshell. So savings for finance and investments. So all the savings are promoted for economic growth. So finally, orderly mechanism and structure in economy. So far, what we have mobilizing the monetary resources for capital from surplus sectors. Where it is surplus, that is transferred to where it is needed. Distributed resources to needy sectors. Transformation of savings into investments and consumptions. Financial markets, place where the above activities are taken place. So this is just overview of financial system in India. So next class we are going to see the markets. Okay, I will take the attendance. So if you wanted to know anything here, you may put it in the chat box, or you may ask 61